Good morning. I'm Jeff Christian, CPM Group Managing Partner. I'm joined today with Rohit Savant, our Chief Precious Metals Analyst and Director of Research, and the primary author of our yearbooks and other precious metals research, and Carlos Sanchez, who's Director and Partner of CPM Group as well, and participates in the research projects as well as handling asset management and commodities management programs. We have a nice long presentation today, and then we have questions. And I have to say that we have an enormous number of questions that were written in by people registering to participate in the conference as observers and listeners. Really good questions, and we could spend many hours answering all of them. Unfortunately, we're not going to be able to address all of them. Some of them will be addressed by the contents of the body of the presentation. Others then will go into a question and answer period and try to wade through some of the questions. A lot of questions about rhodium, but there are also questions, very important ones, about platinum, palladium, iridium, not too many about ruthenium, and some gold and silver thrown in. We want to thank our partners and our sponsors. Our sponsors have included Stillwater Critical Minerals, which is exploring PGM properties up in the northwestern part of the United States. Kitco Metals, refiner, as well as Kitco Media, purveyor of much information related to precious metals. Coralin Economics Report, NOAA Capital Markets, a South African institutional investor that we've worked with since 2004. Umicore, one of the major refiners and producers of PGMs and PGM fabricated products. The Institute of Scrap Recycling Industries, which includes companies that recover precious metals from secondary materials at the end of life, and I assume also some process scrap. Sabin Metals Group, which is one of the premier precious metals, Platinum Group Metals, especially refiners, and Monex Precious Metals, which is one of the largest, longest running, we think most reputable precious metals retail investment houses in the United States. In China, we have the China Gold Association, China National Gold Group Corporation, and Beijing Yicheng Technology as partners. They will translate this report into Chinese and distribute it in the Chinese market. And we have to thank all of them, the sponsors as well as the Chinese partners, because they help make this report at $160 US affordable for a lot of investors. We also have media partners and distributors, Kitco Media, the media arm of Kitco Metals, Metals Daily, and Introact, which distribute our research and commentaries to investors far and wide, really on a global basis. We've done something a little bit different with the Platinum Group Yearbook this year, in that we have an introduction where we discuss issues related to gathering quality, accurate, unbiased data on supply and demand for Platinum Group metals. I personally began researching precious metals, Platinum Group metals, in 1979 when I was a reporter at McGraw-Hill, which is the successor of S&P Global. And I started covering precious metals. I had been covering energies and other metals and electric vehicles and new other industries prior to that. There was not a lot of data around, and we started pulling together research that allowed us to come up with supply and demand estimates back to 1976. We had some data going back as far back as 1900, but it wasn't thorough enough to give you a good supply-demand balance. But we were able to come up with numbers that we thought were pretty good from 1976 forward. 1980, I left McGraw-Hill and I went to J. Aron, which had a research department, a fundamental research department that developed estimates on gold and silver supply and demand, as well as doing research across other commodities from copper to oil to coffee and cocoa. I added Platinum Group Metals, and in 1981, Jay Aaron published what a lot of people think was the first Platinum Group Metals review and outlook, May of 1981. That pretty much was the beginning of PGM supply and demand data. At the time, South African producers didn't even report how much metal they were producing, let alone costs or inventories or other factors. The other major producer was the Soviet Union, and all of that information was state secrets. And then you had secondary refiners, fabricators, and investors, all of whom had no legal or regulatory requirement to disclose how much metal they were refining or using in their products or investing. So you had an extremely opaque PGM market. And when I first proposed doing the 1981 report, I remember my bosses, the chairman of Jay Aaron, saying, is there enough information to produce a Platinum Group Metals report on a standalone basis? And yes, there was. So this is really like 42 years since we started producing annual Platinum Group metal reviews and outlooks. And in the first part, the introduction to this year's report, we talk about issues related to the quality of data that's available, not only on Platinum Group Metals, but also on gold and silver and on commodities in general, because we tend to beat ourselves up in the precious metals market talking about the secrecy and the opacity of good data and the enormous amount of bad data and bad information, misinformation, disinformation that circulates in these. But if you look at other commodities, even the oil market, there is a paucity of information on demand side, fabrication demand, as well as investment demand. Investment demand for precious metals is much more important than it is for other commodities. And that presents a lot of problems. We'll get questions. One of the questions that we got today was, how is it that the platinum price can be so low if certain groups that market platinum investment products keep saying that there's a 1 million ounce deficit? And the answer is, well, there's probably not a 1 million ounce deficit. In fact, there's a surplus, according to our data. And there has been a surplus over the last several years. And there has been a surplus for something like 40 of the last 47 years. And just in the last 4 years, you've had 1 million ounces of cumulative annual surpluses of newly refined platinum entering the market relative to fabrication demand. So if you look at surpluses and deficits properly, total supply less fabrication demand, you've had large surpluses, and that's reflected in the price of platinum. Now, these are our intermediate term, 1 to 3 year buy and sell recommendations since December 1980, when I started working at Jay Aaron. And you can see the first thing I did, the first day I was there, they said, what do you think about platinum? I said, I think it's a sell. And it was. And then in 1983, actually December of 82, I said, okay, I think platinum is down. We've gotten through the recession. We're going into a recovery. The auto industry, which is the major user of platinum and other metals, is now turning itself around. People are buying cars again. Automakers are buying cars again. It's time to buy platinum. And we held that recommendation for about a year. I won't bore you with all the other things. You can see buy and sell back and forth. And the important thing to the discussion here, these buy and sell recommendations were based on CPM Group's fundamental research of the platinum market. And we have gold, silver, copper, palladium, and other markets where we have done this too. We base our price expectations on a fundamental microeconomic analysis of the individual metal or commodity market that we're looking at. If our supply demand data was bad, our price projections would be bad. But you can see here, we've got a stellar record, published recommendations of buying and selling PGMs predicated on our statistics. So sometimes people say, hey, why does CPM Group have data that's radically different from people who are marketing Platinum Group metals to investors? And why do you use your data instead of theirs? And the answer is very simple. We use our data because it gives us a good view of what's really going on in the platinum market, and the palladium market, and the rhodium market. Several years ago, we'll talk about rhodium later, a lot of questions about rhodium in the questions that were submitted beforehand. Several years ago, we started saying that the rhodium market was about to hit a wall and prices would go parabolic. And then they'd come down the way they always do, although maybe not as far down as they were when they were $170 an ounce. Other people were saying, oh no, that's not going to happen. It did happen, and it has happened. And our statistics, our analysis of what's really going on in supply and demand of rhodium gave us a leg up on that. So we have a discussion at the beginning of this report, which I think a lot of people should read, because it also has a lot of historical anecdotes about the PGM markets and the evolution of PGM research over the last 45 years since we began studying the market. Now, I'm going to pass the baton to Rohit in a few pages, but he wanted me to talk a little bit about where we are economically, and also the prices and inventory levels that we've been looking at and are looking at. So on a global economic basis, this is a chart that, we modify it on a quarterly basis. We adjust our economic projections, but it's pretty much been the same. We have expected real economic growth to continue this year. We've been projecting that there would be a recession in the advanced economies of Europe, Japan, the United States, possibly in 2024, 2025. That was our most likely scenario. It hasn't happened yet. Economic activity has outpaced what a lot of other people were saying. A lot of people were talking about a recession in 2022, then it was going to be 2023. Now they're saying 2024, well, maybe the fourth quarter of 2023. But the reality is that the economic activity in the United States and Europe and Japan and China's had some issues, but the economic activity has been positive, and it's been better than the consensus forecast. We continue to view the economy as facing a lot of issues. We would not be surprised to see a recession in 2024 or 2025. We do believe there's one coming, at least in the advanced economies. The rest of the world will suffer because the advanced economies are the marketplace for the goods and services that the rest of the world provide. But we think it's a ways to go. That's important because when you when Rohit talks about some demand in the auto industry, which is the major user of platinum, palladium, rhodium, a recession in the next couple of years could negatively affect PGM demand in the auto industry. Talk a little bit about prices and inventories. And a lot of the questions were, where do you think the platinum, palladium, and rhodium prices are going to be over the next year or so? Our expectation, you can see here that rhodium, platinum traded between $800 and $1,000 for most of the time since late 2015. It's been trying to break out of that range over the last 2 or 3 years, 2.5 years. Our expectation is that ultimately it will, but it could take a while yet. We have seen spikes up to $1,200 and $1,300 due to various developments, the Russian invasion of Ukraine in early 2022, economic factors in the first quarter of 2021. Our expectation is the price probably stays below $1,100 now and trades, let's say, between $900 and $1,100 for the next several quarters. At some point, we do think that the price will move higher, and Rohit will explain some of the reasons why we think that. but we don't think it's going to be yet this year, and we don't think it's going to necessarily be next year. I mentioned those surpluses in the platinum market over the last several years. These are the cumulative surplus since 1976. We started calculating this in 1979, 1980, and we estimated at the time that there were about 4 million ounces of refined platinum in inventories in 1976. And a big chunk of that actually was owned by the Soviet government. There was also several 100,000 ounces of platinum that was owned by the United States government, which I'm proud to say that CPM Group, the Defense Department wanted to sell it, but Congress blocked it for many years. CPM Group helped create the Platinum Eagle, and we used that DLA platinum as working inventories. And then we bought it off of the DLA as we sold coins, as the US Mint sold Platinum Eagles. And we were able to solve the Defense Department's desire to get rid of platinum that it felt it did not need for the strategic stockpile without disrupting the market, because the Platinum Eagles were only bought by investors who wanted to buy Platinum Eagles. So it was, in a way, an off-market transaction. But you can see there was a big period of investment, of addition in 1988 to 1992. That reflected increased South African production in advance of Europe bringing in emission standards, followed by the dissolution of the Soviet Union and excessive sales of platinum, palladium, and rhodium, and diamonds and gold inventories by the government officials who were responsible for exporting those metals in a post-Soviet era. That ended in 1996. At the end of 1996, the Ministry of Finance came in and changed the policies, and you saw a little bit of a dip down. But then in 2002 to 2010, you saw large purchases of platinum by investors. And we know those were investors. They stopped buying around 2008, 2009, 2010. They sold a little bit 2012, 2013 into early 2014. And since that time, they've started rebuilding their inventories. And as I mentioned, you've had a cumulative surplus of about 1 million ounces of total newly refined platinum relative to fabrication demand that's come into the market over the last 4 years. Not all of it, but a portion of that has gone into investor holdings, because investors were looking at that price and saying, okay, $800 to $1,000 can't last forever. And when the price breaks out, I bet it's going to break out to the upside. Palladium's been the opposite story. So a period of very strong growth in palladium prices. Auto users were using palladium at the expense of platinum wherever they could, and investors were buying palladium. And other companies and other industries, electronics and chemical process companies, were buying a lot of palladium. And that drove the price of palladium to record prices. I mean, this only goes back to 2013 and $750 palladium. When I started in the business, I believe the palladium price was $42 an ounce. And it traded between, say, 80 and 180 for much of the period of time from the 1970s into the Audis into this century. There has been a shift away from palladium toward platinum in some portions of the automotive catalytic converter market, and there has been an increase in supply of palladium in response to the earlier growth in fabrication demand. That has led to a period which we've seen really since the middle of 2021. It was interrupted by the Russian invasion of Ukraine, but we've seen palladium prices come off sharply. They got to $3,000 in 2021. They got to about $30,300 in when the Russians invaded Ukraine for a day, came down, and the price now is trading around, well, it's at $1,268 as I speak. Our expectation is that the price will stay low. We don't know that it's going to continue to decline over the next few years, but we don't see it rising sharply. So our projections for the next few years, which are published and updated on a monthly basis in our Precious Metals Advisory Report and other reports that we make available to paying clients. Our expectation is the platinum price is going to probably find a base above $1,000 over the next few years. We don't see it necessarily rising. And as with platinum, there's a lot of palladium around. Interestingly, we've seen investors adding to their inventories over the last few years. The last of the metals before I kick it over to Rohit is rhodium. And as I said earlier, we were starting to talk years ago, and Rohit will fill in blanks there. We were talking years ago about the idea that the rhodium market has been living off of inventories for most of the last 4 decades, since the auto industry started using it to clean up NOx emissions, and that those inventories probably were at critically low levels, and the price of rhodium might go parabolic. It did. It went much further than we thought. Well, we didn't ever put a price on it, how high it could go. It went to $30,000. It's come down and it is now below $5,000. Our expectation is that the rhodium market has changed, and after deficits, annual supply deficits relative to fabrication demand over the last 45 years, you now are in a situation where you have significant increases, surpluses of newly refined rhodium coming into the market relative to how much fabricators want. The auto industry is trying to use less rhodium. The glass industry, which is perhaps the second largest use of rhodium, has drastically reduced its rhodium content and actually sold off inventories starting in 2021. And those changes have led to surpluses over the last 2 or 3 years, which may persist for several years more and keep the rhodium price down. That's all I have right now. I'm going to try to kick this over to Rohit and let him take over from here. And I'll be back for the question and answer period. Rohit, it's yours.
Thank you, Jeff. So before I get into the specific metals and talking about their supply and demand fundamentals, I just wanted to go over some broad market trends that we've been seeing, which affect and influence all of the PGMs. So on the fabrication demand side, you have the electrification of the auto sector, which is probably one of the most important factors that has been influencing and is expected to continue influencing the PGM sector. It is a negative factor for PGM fabrication demand, but not all of it is negative. It's really the battery electric vehicles or the pure electric vehicles which do not use auto catalysts, which is negative for PGM demands. But you also have hybrids and plug-in hybrid electric vehicles, which continue to use PGMs in some shape or form, which we think is something that needs to be kept in mind in terms of at least the near to medium term impact of the electrification of the auto sector. So when you look at passenger vehicle market share for battery electric vehicles, the vehicles which do not contain an auto catalyst, that stood at about 10% last year, which was up from around 8% in 2021 and up significantly from about 2.5% in 2019. So there's been a pretty substantial growth in the market share of BEVs over the last 4 years. We do think that the market share for these vehicles will continue to rise. But this has really been the increase in market share for BEVs has really been coming from just 3 markets, China, Europe, and the US. And even within these markets, the US has really been lagging Europe as well as China. It had about 6% of passenger vehicles that were BEVs last year. And then in Europe, while there has been a bigger market share being taken up by the BEVs, which stood at about roughly 14 or 15% last year, there has been a much stronger growth in demand for hybrids and plug-in hybrid vehicles, which continue to use catalysts similar to the ones that are placed in internal combustion engines. So there is this support to PGM demand from these vehicles, and we think that hybrids and plug-in hybrids will continue to play a role in these markets, at least while this transition continues over the next several years. Now, the electrification of the auto sector affects each PGM differently. The worst hit among the three PGMs is Palladium, and that's primarily because of its large exposure to the passenger vehicle market. Platinum is sheltered to some extent because of its exposure to commercial vehicles and its strong presence in that market. BEVs have not really made a lot of headway in the commercial vehicle sector, especially with trucks and long-haul commercial vehicles. And then Rhodium is affected negatively. It's less negatively affected than Palladium, but more than Platinum. So it's somewhere in between those two metals. Then you have fuel cells. There is an expectation that fuel cell demand would positively influence Platinum. There is a lot of technical as well as cost issues related to fuel cells, which are being worked out right now. And this is something that we think would take a few more years to get sorted out. While that is happening, there is an ongoing effort to reduce the amount of platinum from fuel cells and to develop fuel cells which do not contain platinum. So how positively fuel cells affect platinum in the future is there are lots of questions around that, because we don't necessarily know how long it would take for fuel cells to become a large enough source of demand for platinum. And then in that process, we do not know if platinum would continue to play an important role in the fuel cell sector if they do develop. They already have developed fuel cells that do not require platinum, but if they can develop or improve the technology sufficiently to make those non-platinum fuel cells as efficient as the ones that contain platinum. So the future demand for platinum from the fuel cells could be positive, but may not be as positive as some of the expectations in the market. Then you have thrifting and substitution. So you saw a strong rise in Palladium and Rhodium prices over the past few years. There's always an ongoing effort across applications to reduce the amount of precious metal loadings. When you see the kind of sharp increases that you saw in Palladium and Rhodium prices over the past few years, that effort tends to be accelerated, and so we've seen that happen. One of the big beneficiaries of this thrifting and substitution has been platinum, where because platinum prices have been sort of moving sideways pretty much since 2015, there has been a move, as we've seen in the auto sector, where platinum's been reintroduced into gasoline auto catalysts, and in the glass sector, where platinum is being substituted for rhodium. So platinum does stand to benefit from this, from the sharp increase that we saw in Palladium and Rhodium and the resulting thrifting and substitution. Palladium is definitely taking a bigger hit from the substitution, and that's because of the auto sector being a much larger market than, for example, glass, where rhodium is getting negatively affected, but it is a much smaller market than what the auto sector is. It should be noted, though, that while platinum has been used as a substitute for palladium as well as rhodium, it has not completely substituted either of those metals in the auto sector or in the glass sector. So you still continue to see demand for both those metals in those two sectors. While a lot of the auto-related or fabrication demand-related factors are positive or less negative for platinum, the one factor that has been negative for platinum fabrication demand is an ongoing reduction in the diesel passenger vehicle market. Diesel catalysts contain a good amount of platinum, and so the reduction in the market share of diesel passenger vehicles, especially in Europe and India, is something that has hurt platinum fabrication demand. And this is a trend that we expect to continue seeing over the next several years. And then you have macroeconomic trends. So macroeconomic factors play an important role for fabrication demand. The global economy has held up pretty well so far, despite a sharp increase in interest rates around the world. You also have been seeing inflation coming down. Both of these factors are in line with what CPM was thinking and has been saying for some time now. We did say that while interest rates have risen strongly, they have risen from an extremely low level, and interest rates today as well are not as high as they have been historically. If you look prior to the 2008-2009 period, interest rates today are still on the lower end. So the negative impact of this on the economy has not been as strong as some market participants expected. We do think that economic growth would slow in the coming quarters as the tightening monetary policy that we've seen over the past year starts to have a more pronounced impact. But we do not foresee a recession until later in 2024 or possibly in 2025. So what all of this means for fabrication demand is that at least in the short to medium term, fabrication demand for all of the PGMs should be supported from a macroeconomic point of view. And then you have supply related trends. So the sharp increase that we saw in palladium and rhodium prices over the past several years resulted in a lot of mining companies focusing their efforts on mining palladium-rich ore bodies or developing palladium-rich ore bodies. So you are going to see a increase in mine supply for palladium in the next few years, which unfortunately comes in at a time when fabrication demand is likely to soften for the metal. And then also on the scrap supply side, you have platinum scrap supply in a long-term declining trend. That declining trend has to do with the reduction of platinum being loaded in auto catalysts and the reduction in the market share of diesel passenger vehicles. And you simultaneously are seeing an increase in palladium scrap supply, which is really because of palladium being used in place of platinum in these auto catalysts, which are now coming back into the market. So again, we expect these trends to continue over the next few years, where platinum scrap supply would reduce and palladium scrap supply would see more increases. So with that, we'll move on to platinum. Total platinum supply, which includes platinum mine supply and scrap supply, stood at about 6.6 million ounces in 2022, which was down around 5.5% since 2021. The decline that we saw in 2022 was driven by a reduction in both mine supply as well as scrap supply. Mine supply was down around 4%, while scrap supply came off about 10%. So the decline in 2022 mine supply was a result of reduced output from South Africa as well as the US. In the US, production was hit by the flooding of Sibanye-Stillwater's mines in the US. Meanwhile, in South Africa, you had a variety of factors negatively affecting South African platinum production, which I'll deal with or address on the next slide. Scrap supply, meanwhile, stood at about 1.13 million ounces in 2022, which was down 10% from 2021. As mentioned before, scrap supply has been in a long-term declining trend, but last year's 10% decline was an outsized decline primarily because of the sharp gains that we saw in 2021, which were in comparison to the weakness in scrap supply during 2020. So, as I mentioned before, platinum scrap supply has been declining because of the substitution of substitution of platinum with palladium in gasoline autocatalysts. You did see some support for scrap supply, platinum scrap supply from the European market because a lot of the diesel passenger vehicle catalysts. So the European market had about 55% of its passenger vehicle market share coming from diesel in the late 2000s. And so a lot of those catalysts started re-entering the market of the past few years, and that helped to provide some support to platinum scrap supply. But since then, the market share, since the late 2000s, the market share for diesel in passenger vehicles has been declining. So going forward, we think that the catalysts that are coming in would be fewer catalysts from the diesel passenger vehicle market, and so there'll be lesser amount of platinum being collected in scrap. In addition to these catalyst-related factors that were hurting scrap supply last year, there were also some broader market factors that hurt scrap supply. For one, owners were holding on to their vehicles for longer, in part because vehicles have been lasting longer, in part because there was lesser usage of vehicles during COVID. And so all of this helped to push the average age of vehicles higher to record high levels, in fact, in 2022. You also had a reduction in or a shortfall of semiconductors, which was hurting auto production and was increasing the demand for used vehicles, which consequently reduced the amount of vehicles available for scrap. We also had reduced scrap supply coming from China because of reduced scrappage of commercial vehicles on account of weaker economic growth there. And so all of these factors collectively helped to weigh on platinum scrap supply last year. This year, we do think that total platinum supply will rise. We expect a marginal increase of about 0.3%, supported by both mine supply as well as scrap supply. And we think that total supply will rise to about 6.68 million ounces this year. So as mentioned before, South African platinum production was down in 2022 for a variety of reasons. These reasons included Eskom load shedding, safety-related issues, delays in the rebuild of smelting capacity, and theft of copper cables, which were negatively impacting operations in South Africa. So you had all of these factors, some of which have been long-standing issues in South Africa. For example, the electricity issue or the labor safety issues. These have been long-standing problems. They have resulted in costs rising. They have resulted in reduced mining investment in the country, which has played an important role in weighing on total South African platinum mine supply over the last several years. So as you can see, South African platinum mine supply peaked in 2006 and has really been in a declining trend since then. In 2023, we think that electricity supply would be a major issue for platinum mine production in South Africa. It not only can affect negatively mine production, but it also could negatively affect the smelting process, which is an extremely energy intensive process, and that could negatively affect the amount of refined platinum supply coming into the market this year. The ramp up of the Marikana K4 project is expected to support South African platinum mine supply, but we don't expect any strong increases in platinum mine supply this year from South Africa. Sorry, I'm having some trouble moving this presentation forward.
Rohit, if you want, you can kick the screen back to me. I can, oh, you got it. Okay.
Yeah, I'm not sure why it's moving so slowly. So this chart shows you the South African rand versus the US dollar. The South African rand hit a record low versus the US dollar in 2022. The weakness in the South African rand has been positive for South African mining companies, primarily because it helps these mining companies to subsidize their costs. The South African mining companies have their revenues in US dollars and their costs in rand, and this setup helps them to subsidize their costs, which encourages high cost mining. Problem with this is that it increases supply, which ends up weighing on the US dollar price of platinum. And in theory, this weaker price should curtail supply, but because of the subsidizing of cost due to the weakness in the rand, you continue to see more mine supply coming on the market than the market needs. And this is something that we think would act as a headwind to platinum prices going forward. The South African weakness in the South African rand is likely to continue. You are going to see periods, as you have in the past few weeks, where the rand has strengthened, but the trend in the South African rand is likely to continue to be one of weakness, and that is something that is going to continue to support platinum mine supply out of South Africa, increasing supply and weighing on the US dollar price of the metal. So capital expenditure in South Africa rose to a record high 30 billion rand last year. This was about 1.76 billion US dollars, which was the highest level of capital expenditure in South African PGM mining since 2012. About 2/3 of that capex was aimed at stay in business activities, and the balance 1/3 was diverted towards expansion projects. You had all the major PGM mining companies in South Africa increasing their capex expenditure last year. Now, one thing to keep in mind about this increased capital expenditure, especially towards expansion projects, is that that increases from an extremely low base. it still accounts the expenditure on project expansion still accounts for the minority of capex expenditure, and we're not entirely clear or sure how long this kind of expenditure is going to last, especially given the uncertainty regarding future demand for PGMs from the auto sector. So PGM cash costs last year rose for the 4th consecutive year and reached a fresh record high of $975 an ounce. Costs rose for a variety of reasons. You had the broad inflation impact, which pushed up input costs across the mining sector. You had a decline in the amount of PGM production, which reduced the amount of ounces over which those costs could be spread. You had high labor costs as a result of tight labor market conditions, as well as a shortage of skilled labor. And you had high electricity costs. So a combination in South Africa. So you had a combination of all of these factors coming together, pushing costs higher. Costs did not rise only in South Africa. They rose across mining regions during 2022, and that's what helped to push up these costs on an average basis last year to record high levels. So platinum fabrication demand stood at about 6.2 million ounces in 2022, which was down roughly 6% from 2021 levels. You had COVID-related restrictions in China, which hurt commercial vehicle demand as well as jewelry demand. You had the Russia-Ukraine war, which hurt auto demand in both those countries as well as in Europe. You had the shortage of chips, which is an overall headwind to the global auto market. You had the growth in battery electric vehicles, which again was a headwind to platinum demand. So you had a lot of factors that weighed on platinum fabrication demand last year. This year, platinum fabrication demand is forecast to rise about 5.5% to around 6.6 million ounces. The easing of the chip shortage that we've been experiencing over the past 2 years is one of the most important factors in supporting platinum fabrication demand this year. We've also seen an increase in commercial vehicle demand in the first half of this year, which we think would continue into the second half of the year as well. And then you have the removal of COVID restrictions in China, which again we think would be a factor that would support platinum fabrication demand. You do have an ongoing headwind from the growth in BEV, but as mentioned before, this is less of a concern in platinum than it is for the other PGMs. So some of these next slides basically help or illustrate the points that have already been made in the presentation. So what you're looking at here is commercial vehicle demand from some of the major markets last year. As you can see in the chart on the left-hand side, that is commercial vehicle demand in developed economies, and it was down pretty sharply in Europe. In developing economies, as you can see in the chart on the right-hand side, it was down in most markets with the exception of India. So last year, besides the US and India, commercial vehicle demand was down and down sharply in most markets, which played an important role in weighing on platinum fabrication demand last year. This year, I'm sorry, it seems. Jeff, can I pass this presentation to you for moving the slides forward? I'm sorry, I seem to be having some issues with moving this presentation forward. Okay, here we go. So this slide shows us commercial vehicle demand so far this year, or rather in the first 5 months of this year. There has been strength in most major markets, and we expect that strength to continue given that economic growth is holding on and holding up well at the moment, and we expect that to continue through this year. So that should be something that supports commercial vehicle demand and should support platinum fabrication demand as a result. This chart shows market share for diesel in the passenger vehicle markets of various countries. As you can see, there has been a sharp decline in diesel passenger vehicle market share in both Europe as well as India. India has seen some stabilization at a lower level. In Europe, the market share continues to decline, and we think that this trend is likely to continue into the future. So this is definitely something that would act as a strong headwind to platinum fabrication demand in the short to medium term. What you can see on this chart is the market share of different types of passenger vehicles in Europe. While diesel market share has been declining for several years now, initially a lot of that market share was being taken up by gasoline engines, but since 2020 that has changed, and you're now seeing that there is a shift away from both diesel as well as gasoline engines towards either battery electric vehicles or alternate power engines, which includes hybrids. And again, this chart illustrates that point which was made earlier, that you are seeing an increase in battery electric vehicle market share in Europe, but you're seeing a much larger increase in the market share of hybrids in Europe, which continues to be something that would support PGM demand. This chart shows BEV market share on a global basis. Last year, BEVs accounted for around 10% of passenger vehicle market share. This year, they're expected to account for a little more than 11%. I guess the important point to take away from here is that you still have about 90% of global passenger vehicle market using a auto catalyst, and something that would continue to provide support to PGM demand. This is the platinum palladium price ratio. You have seen a uptick in this ratio since last year, to a large extent as a result of weakness in palladium prices. This ratio may continue to rise in the near term. But that said, if you look at it historically, this ratio is still close to record low levels. And so this continues to provide an advantage to platinum because of platinum's relatively lower price compared to palladium. So both fabricators and investors would view this relatively lower price of platinum as desirable. And so that's something that should, again, support platinum fabrication demand as well as investment demand. So what you're looking at here is the platinum market surplus deficit. So while platinum supply declined in 2022, platinum fabrication demand declined even more than platinum supply did. And that ended up resulting in a 442,000 ounce surplus in the platinum market, which was the highest platinum market surplus since 2011, when it stood at around 813,000 ounces. So platinum's price performance during 2022 suggests that investors were not really interested in buying this metal aggressively. There was some interest in platinum investment early in the year when the Russia-Ukraine war broke out because of the concerns about PGM mine supply coming out of Russia. But that sentiment turned negative pretty quickly. You had tighter than expected monetary policy during 2022. You had the COVID-related restrictions in China. You had an ongoing shortage of semiconductors, and you had a concern of a recession during the second half of the year. So all of those factors overpowered any concern about supply disruptions from Russia and reduced investment demand or the desire among investors to be buying platinum, which is heavily reliant on fabrication demand. This year, supply is forecast to remain mostly flat, but demand is expected to rise strongly, which is expected to shrink the surplus in the market down to around 128,000 ounces. And while the market surplus is expected to decline this year, we don't necessarily expect platinum prices to rise strongly in response to that. Part of the reason for that is there's a massive amount of platinum held in inventories. And also investors are still pretty cautious about adding metal to their holdings. So in part because you've seen nearly a decade of basically sideways moving platinum prices. And while the sentiment is turning more positive, there still are some concerns about the future demand of platinum because of the ever-evolving nature of the auto sector. So we do think that platinum investors would remain somewhat cautious in adding platinum to their inventories this year. So this is platinum ETF holdings. Last 2 years, we've seen platinum ETF investors essentially turning to being net sellers of the metal. Those net sales ended up reversing some of the net purchases that were made during 2019 and 2020. This year so far, investors have remained net buyers of platinum in the ETFs. They've added a little over 200,000 ounces. And we think that this would continue, but we do not expect investors to be adding metal the way they did in 2019 and 2020. Coin fabrication or coin investment demand also remained at elevated levels. It was off from the 2021 levels, but it still remained high. There's a lot of mints offering platinum products. The one mint that did have a reduction in its production was the Perth Mint, but outside of that, there has been an increase in investor interest as well as mints producing these coins, which has helped to keep platinum demand from the sector at elevated levels. So with that, we move on to palladium. Palladium, the total supply of palladium stood at around 9.1 million ounces in 2022, which was off around 4.5% from 2021 levels. The decline in palladium supply was an outcome of both a reduction in mine as well as scrap supply. Scrap supply declined to a large extent for the same reasons that platinum scrap supply declined last year. The one difference was that there was a bit of a buffer in the case of palladium just because of the increase in palladium loaded in various auto catalysts over the past decade or decade and a half, and that material coming back into the market helped to provide some support to palladium scrap. Palladium mine supply declined again in the same regions that platinum mine supply declined, South Africa and the US. Russian output for palladium rose during 2022, offsetting and reversing some of the losses from 2021, which were caused due to the flooding of mines in Russia during that year. This year, we think that total palladium supply, which would include mine supply and scrap supply, will stand at about 8.9 million ounces, down around 2.3% from 2022 levels. We expect the decline to be driven by mine supply, with scrap supply essentially rising this year. So mine supply is expected to decline due to lower Russian output. Operational challenges have been mounting at Norilsk Nickel, and the company expects the Russia-Ukraine war to continue adversely affecting its operations. So the company is undertaking a asset modernization and repair program this year, which we think will weigh on total PGM supply coming out of the company. Palladium fabrication demand stood at 8.25 million ounces in 2022, which was down around 4.8% from 2021 levels. Demand declined in all of Palladium's major uses except the chemical and petroleum refining sector, where production capacity expansions helped to drive Palladium demand higher. Demand for Palladium was hurt due to a variety of reasons last year. You had the delays in auto production due to the chip shortage. You had the partial substitution of Palladium with platinum and gasoline auto catalysts. You had the expansion of BEV market share, which, as mentioned earlier, definitely hurts Palladium more than any of the other PGMs. And then you also had weakness in the electronics sector, where reduced demand for electronics, both from consumers and businesses, weighed on Palladium demand from the sector. A lot of electronics demand was brought forward into 2020, 2021, because of COVID, you had the work from home policies put in place. And also, there were some concerns about a recession during the second half of last year, which also resulted in businesses pulling back in making investments in the electronics sector. So Palladium demand is projected to increase this year to about 8.6 million ounces, up roughly 4% from 2022 levels. That increase in Palladium demand is primarily driven by recovery in the auto sector. BEVs and the substitution of Palladium with platinum are two trends that will continue this year and will continue to act as a headwind to Palladium fabrication demand. Electronics demand is also expected to remain weak this year, but the rate of decline in demand from the electronics sector is expected to be less than that which was seen last year. So what we're looking at here is Chinese vehicle sales, and as can be seen, they rose pretty strongly in 2022, which provided some support to PGM demand, but it was not as the support to PGM demand was not as strong as these numbers would suggest. And that's primarily because that increase in demand that was seen during 2022 was the result of government incentives which were targeting smaller vehicles and electric vehicles. And the electric vehicles do not really support PGM demand. And the battery electric vehicles do not support PGM demand. And the smaller vehicles, if considering or holding all of the other factors that influence PGM loadings in auto catalyst constant, a smaller vehicle would require lesser amount of PGMs. So even though vehicle sales did rise in China last year, its impact on PGMs was not as positive. In the US, you had weakness in vehicle sales last year. And so that was definitely something that weighed on Palladium fabrication demand. The one factor that did support Palladium fabrication demand was the increased market share, or the large market share, of light trucks in the US, which now account for roughly 80% of US passenger vehicles. So again, because these vehicles are larger, they typically tend to consume a larger amount of PGMs in their auto catalysts. So the Palladium market was in a surplus during 2022, which is a condition that has been in since 2020. The surpluses that we've been seeing over the past few years are a result of both weakening fabrication demand as well as rising scrap supply. The Palladium market was in a deficit between 2016 and 2019, and at that time, investors were outbidding each other to get hold of the metal. Palladium market switched to a surplus in 2020, but prices continued to rise, and there were a few reasons for that. One was there was a broad increase in asset prices, primarily tied to the massive amount of monetary policy and fiscal stimulus that came through after COVID, which helped to push up asset prices across the board during 2020 and 2021. You had recency bias in the case of palladium, where strong and sustained prices since 2015 led investors to believe that that price rally could continue. You had actual supply losses, where in the case of Norris, that was in 2021, and in the case of Sibanye last year at its North American operations. And then you had concerns about lost output. When the Russia-Ukraine war broke out, and there was concern about whether there would be disruptions to palladium mine supply out of Russia. So all of those factors help to keep palladium prices elevated, as well as help them to continue rising despite these surpluses. But the positive impact of these factors is now really behind the market, with investors focusing more on the sustained supply surpluses that we've been seeing in the palladium market, and the concerns of future fabrication demand for palladium. So the investor sentiment has shifted a bit for palladium from what it's been in the past few years. And that's why we have been seeing the recent weakness that we've been seeing in palladium prices. There's also a massive amount of palladium inventory that is being held by investors, the Russian government, market makers, and industry. We estimate that the inventory stands at about 17 million ounces. And we do think that some of this is expected to come back into the market. That coming back into the market is going to act as a headwind to palladium prices in the medium term. About 11 million ounces of that 17 million ounces, so around 60% of it, was built up during that 2001-2007 period. The annual average price of palladium back then on a nominal basis was $325, and on a real basis was $460. So it's still, all of that inventory was built up at prices significantly lower than where they are even today. And so there is a strong likelihood that at least or most of this inventory will continue to be held by these inventory holders, and it's not likely to come back very easily into the market. It's more the inventory that was built up in recent years that is likely to come back into the market and act as a headwind to palladium prices. So palladium ETFs have essentially been net sellers of the metal since 2015. These investors have been selling into the price rally. Last year was no different. They continued to be net sellers. This year so far, during the first half, they have been net buyers, but they've been net buyers of extremely small amounts of palladium. And this net buying could very easily shift to net selling over the remainder of this year. So with that, we move on to rhodium. Rhodium total supply stood at 962,000 ounces in 2022, which was down around 2.5% from 21 levels. The supply declined because of a reduction in rhodium's two main sources of supply. One is automotive scrap, and the other is South African mine supply. Rhodium total supply is forecast to rise marginally in 2023 because on the one hand, while we do expect scrap supply to recover, we expect mine supply to continue to remain weak during the year, which we think will weigh on total rhodium supply during 2023. Rhodium fabrication demand, meanwhile, stood at 843,000 ounces last year, which was down around 4% from 21 levels. That weakness was a result of an uptick in thrifting of rhodium across its uses, which should not be surprising given the sharp increase in prices that we saw in the past few years. The substitution of rhodium, especially in the glass industry, and then the overall weakness in the auto market. So all of these factors collectively weighed on rhodium fabrication demand last year. Rhodium fabrication demand this year is expected to rise strongly to about 900,000 ounces, which would be a 7% increase from last year, and would be the highest level of demand since 2019, when it stood at about 1.05 million ounces. So it is risen or expected to have risen strongly since last year, but if you look back beyond or before the 2020 level, rhodium demand is still substantially lower than what we had prior to COVID. The increase that we are expecting this year is again primarily driven by the auto sector. Meanwhile, demand from other sectors we expect would remain weak, because while rhodium prices have come off from the levels that we've seen recently, they're still pretty high by historic standards. And then you have the rhodium surplus deficit. So rhodium demand has been falling rapidly in the past few years, which has outpaced any softness that we've seen on the supply side, which has caused the increase in surpluses. So after numerous years of deficits, which helped to push rhodium prices to record high levels, more recently we started to see surpluses built up. This year rhodium is expected to remain in a surplus. Both supply and fabrication demand are forecast to rise, but fabrication demand, it's rising from a much lower level. And therefore the market is still expected to remain in a surplus, which we think will start to weigh or has already been weighing on rhodium prices. So with that, I'll pass this back to Jeff to talk about the minor PGMs.
Can you pass the screen back to me? Okay, thank you, Rohit. I'll just talk briefly about the last three metals, and it's interesting because these have always been the minor PGMs, and I see that now some people are paying more attention to them than they have in the past. Ruthenium, iridium, and osmium. They are relatively smaller markets, and ruthenium market in terms of ounces is perhaps as large as or larger than the rhodium market, but the price is far lower and has traditionally been far lower than that of rhodium. So it's been considered something of a minor metal. These are metals that are, the Platinum Group Metals refineries are great. They're like giant chemistry sets, and they're really neat. And you take the map from a smelter and you start extracting metals of palladium and then the platinum and then the rhodium. And you get to a point where you say, okay, I've got ruthenium and iridium and osmium here, and there's a lot of metal lying around and there's not a lot of demand historically. So I'm just going to leave it in these barrels of tank house slimes, unrefined metal. And what we've seen over the last several years is demand for iridium and ruthenium, and to a lesser extent osmium, have risen sharply in a number of technologies, electronic, electrochemical, using in iridium to make crucibles in which to grow crystals for LEDs. Then the iridium is actually used in the LED lighting. Ruthenium is used in a lot of electrochemical processes, making chemicals and pharmaceuticals. And osmium has also found some new uses, in part as a substitute for more expensive metals like iridium. So as a result, you've seen a shift in the prices. This is ruthenium, and you can see here, the price was trading around $40 an ounce, $30 an ounce 8 years ago. And you've seen strong demand for this metal. And there is metal in unrefined form and in refined form above ground and in inventories. and it's being processed into usable metal. And you've seen this upward shift in the fabrication demand curve, which has been reflected in an upward shift in the price. So the price initially went up to around $250 an ounce around 2019, 2020, and then it spiked as high as $800 in 2021, came off in 2022, but it's still around $400, and it seems to be finding a base. CPM Group has 10-year projections for a lot of metals, manganese and molybdenum and tantalum and niobium, gold and silver, platinum and palladium and rhodium. We have projections out to 2050, supply, demand, and price under different economic scenarios. We take those metals out to 2050 because of what we expect to be a long and protracted energy transition in motive propulsion technologies. And the next 10 years, we don't think will be as significant as a lot of other people think. So we're taking our platinum, palladium, rhodium out to 2050. Ruthenium, iridium, we're taking them out 10 years. And for at least the last 4 or 5 or 6 years, the title of our long-term ruthenium and iridium reports has been the unsustainability of demand. If you look at these, Rohit was talking about the long-term deficits in rhodium living off of inventories for a long, long time. Similar situation in ruthenium and iridium. And the question is how much of those inventories are still there? The expectation and the view that we have is that a lot of the inventories are rapidly being drawn down. And we've seen that, and it's been reflected in the prices of ruthenium and iridium. There are some changes now because of the higher prices. Some fabricators are finding ways to substitute osmium or other metals, or in the case of iridium, they're substituting platinum for iridium in some applications, or moving to platinum iridium alloys to reduce the requirements of the iridium. Not so much the price, but the requirements of getting the iridium supplies. And our expectation has been that over the next decade, you will see further constraints on the availability of metal, and that will lead to lower fabrication demand for these metals simply because the metal's not going to be there. I'm giving a presentation at Rick Rule's Natural Resource Investment Conference down in Florida later this week. And one of the points that I'm making, I'm talking about metals that are going into electric vehicles. And the title of the slides is, if you don't have the metal, you can't build the cars. And ruthenium and iridium are not used in automobiles, but if you can't get the metal, you can't use them in the various processes and equipment that you're talking about. So we've seen a ruthenium price come off, but it's staying high. Our expectation is that it will stay high because of relatively tight supplies of newly refined metal and inventories relative to fabrication demand. The iridium market is even tighter than the ruthenium market. And you see that in the price. Again, the price, was relatively flat for decades. It rose sharply, really starting around 2017 with the expansion of LED lighting and the use of iridium in the manufacture of LED lighting, and then other technological applications for iridium. The price shot way up in 2021 with the economic recovery and just tightness in supply. It has come off, but it hasn't come off as much as ruthenium. As I said, we have seen some substitution away from iridium into platinum and into platinum iridium alloys, which have reduced iridium requirements. Our expectation is that over the next several years, you'll continue to see that, but that will probably be reflected in higher, or not higher than where we are today, historically high iridium prices at recent levels, and possibly even higher to further encourage substitution. Finally, osmium. Osmium has been a very small market, very specialized. We have seen some new uses. The low end of the dealer price that we quote here has gone from $350 an ounce. It was at $350 from like 1997 until 2017. It rose to $400 and it's been stable there. We are seeing some increases in fabrication demand and new uses for osmium. Also, osmium used as a substitute for some of the other 5 Platinum Group metals. There was a push that started to emerge in 2021 to try to convince investors that osmium was a good investment metal. We haven't seen a lot of takers in that thesis, and we haven't seen a lot of investors buying osmium. But the fact is that people who try to sell precious metals to investors, some of them have locked on the idea that osmium is this dark corner. I will point out that if you go back 10, 20 years ago, you could have found G. Gordon Liddy hawking beryllium on cable TV, saying that beryllium was the metal of the future. It hasn't really panned out that well. And they did fail to mention that a lot of people suffer from an allergy to beryllium. I think this thing is called beryliosis, and it could be extremely painful, if not fatal, if you had bought beryllium and put it in your garage back then. There are people who are allergic to Platinum Group metals, and osmium will in some instances give off a poisonous tetroxide. But you have seen some people push into osmium. You've also seen people touting iridium and ruthenium to investors. CPM Group has worked with investors, high net worth individual investors, and some hedge funds and others in rhodium and ruthenium and iridium over the years. We've never had any osmium investments. Our policy is that if you are going to invest in a non-exchange traded metal based on CPM Group's research and consulting, we want to manage the position. And we do that because we saw some bad examples in rhodium, not with our clients, but with other people who bought rhodium in the late 80s, early 90s, and sold it in a very sloppy fashion, driving the price down. In the mid 1990s, we saw it with not CPM Group investors, but other investors in cobalt, also in the 1990s. And we saw it with a fabricator in ruthenium around 2007, 2008. So we advise ordinary investors, anybody but the most sophisticated investors, to avoid rhodium, ruthenium, iridium, and osmium as investments. And if they do want to do it, we request, if we're going to work with them, that we manage the position. Not so much because it's difficult to buy these metals, but it's extremely difficult to sell them. And when you come time to sell it, as that fabricator found out in the ruthenium market in 2007, 2008, you can have $100 or 100% spread between the price at which you can buy ruthenium or iridium and the price at which you can sell it. Because if you're an investor and you bought a small amount of these metals and you call up the dealer that you bought it from, he knows why you're calling. So he'll give you a nice spread. That's what we have. You may go to our website and buy the Platinum Group Metals Yearbook. It has a lot more insights than we've been able to give you over the last hour and 25 minutes. But let's spend about 35 minutes and open it up for questions. And Carlos Sanchez, I think, will join us now and ask some of the questions. While Carlos is setting up, I will, and preparing the first question, I'll deal with one question that an investor asked us, and that had to do with hydrogen technologies. And Rohit, I think, spoke a little bit about fuel cells. We are fuel cell skeptics. We've been waiting for the fuel cell technology to work and to be price competitive for half a century now. Actually, other people have gone back even further. General Motors was working on fuel cell vehicles in the 1960s. I think it still is. And there's this big question as to whether fuel cells would use any platinum or platinum group metals if they became widely used on a commercial basis. I should say, we think that fuel cells have good applications in fleets, managed fleets like intra-city buses or forklifts in warehouses or airport fleets where you have a fleet manager who can control it. And we think that fuel cells have applications in stationary power generation. It's just that we don't think that fuel cells will ever represent a significant portion of on-road vehicles in terms of the propulsion technology. We are, and I personally am very interested in hydrogen engines. And I'll tell you, and it's interesting to note that Toyota and Yamaha have come out with an 8-cylinder hydrogen engine. Hydrogen engines are interesting because the first internal combustion engine, like in 1806, the proof of concept that an internal combustion engine works, used hydrogen as the fuel. Petroleum really wasn't commercialized for another 65, 70 years. So he used hydrogen. He said, see, internal combustion engines work. Internal combustion engines that burn hydrogen are half as expensive as to build as internal combustion engines that burn diesel or petrol or gasoline. And they are a fraction of the cost of a fuel cell. They have fewer moving parts so that they are cheaper to maintain. There are some issues because the hydrogen can really do some significant damage eating into the metal, but that is solved by depending on the alloys that you use in the engine. But there's an anecdote I want to tell, and I hopefully won't spend too much time on it. You hear this, we've worked with companies that are doing liquid organic hydrogen carriers, which can safely and cheaply transport hydrogen using existing systems for gasoline and diesel. You know, you hydrogenate a organic liquid, and then you have a liquid that has the volatility and toxicity of diesel fuel. And you can use the existing distribution channel to distribute that. And then when you have the hydrogenated organic liquid where you want to use it, you use a non-precious metals catalyst, strip off the hydrogen, and use it. You oxidize it in an engine or other application, and then you can reprocess and rehydrogenate that liquid organic carrier. The platinum industry in South Africa likes liquid organic hydrogen carriers and have been trying to figure out which chemicals have enough hydrogen carrying capacity, 5% or more, than that would make them compatible with on-road transportation. Liquid organic hydrogen carriers are used in stationary energy storage systems in Japan and a number of other countries already, but the carriers only hold about 2% hydrogen, which is okay for stationary sense, but if you're going to try to put this on a vehicle, it doesn't hold enough hydrogen. It would be so heavy, the liquids, that it wouldn't work well in terms of the engineering. The auto industry looks at liquid organic hydrogen carriers and says, if you can get me hydrogen cheaply and safely distributed, shipped, stored, and distributed to users with LOHC, liquid organic hydrogen carriers, using the existing infrastructure to distribute that, I will build hydrogen engines. I will shave a couple $1,000s off of the cost of manufacturing each vehicle. I will have a vehicle that is more efficient and has lower repair costs. Now, over the years, we've had numerous discussions with scientists at auto companies, energy companies, electronics companies, engineering firms. And one of the things that you keep hearing is hydrogen engines won't work because if you're using the oxygen from the atmosphere and you're not stripping it out of the atmosphere, you will be putting out not only H2O, water vapor as an exhaust, but also nitric and nitrous oxides, because the major component of air is nitrogen. And you would need rhodium to clean up the nitrous and nitric oxides, as you do now with petroleum-based vehicles. So you wouldn't be using platinum and palladium, so you wouldn't be able to get the rhodium. And several years ago, I was in a meeting with a client and various engineers, and they expressed that view. And I stopped and I thought for a second, and I said, you know, hydrogen oxidizes at 700 to 800 degrees centigrade. So if you're using a hydrogen engine and you're oxidizing the hydrogen with oxygen from the atmosphere, it's operating in those chambers at 700, 800 degrees. Nitrogen oxidizes at 1600 degrees centigrade, twice as hot. If you are using a liquid organic hydrogen carrier or anything, if you're oxidizing hydrogen, you never get to the flash point where you oxidize the nitrogen. And I pointed that out to these engineers and scientists, and our client said, yes, we have tested our hydrogen repeatedly on a bench testing, and we've never picked up any nitric or nitrous oxide in the exhaust from engines that we've used for these tests. And the engineer said, well, we don't know why. And I said, because you never get to the flash point where you oxidize the nitrogen. I sometimes complain about the level of knowledge in US politics and economics, but the reality is that it occurs at the scientific level too. Long story about that, but the reality is that hydrogen can come along. Toyota's looking at it, Ford's looking at it, BMW's looking at it. BMW had a vehicle that it tested a few years ago. Probably almost 18 years ago, there was a very interesting test but by a company that was no longer exists called Energy Conversion Devices on a hydrogen using nickel metal hydrides. And it was a test just to demonstrate that you could get a very good range using a hydrogen without even modifying the gas engine that they used on a little bitty Ford. I'll stop there and I'll ask Carlos to start kicking us some questions.
Yeah, we have several questions that came in, and then other questions that were probably touched on in the presentation, but I'll ask them here that were sent in previously. So the first question is, what is the best way to invest in PGMs? Does any particular mining company or metal stand out?
I'll handle that. Well, first off, CPM Group is a commodities analysis group. We don't make recommendations on mining companies. That said, if you look at the first page of this presentation, you will see Stillwater Critical Metals is a client of ours, and they're exploring, they're in the early stages of exploring. And you can see other companies that are in there. I think that you do have to look carefully at each individual company. In terms of investing in platinum and palladium, we suggest physical metal and futures and forwards and options and ETFs. And we don't recommend individual ETFs either. Rohit, if you have anything to add, just jump in.
Okay.
Okay, Carlos, next question.
Okay, platinum, given the current price difference between platinum and palladium, what is the likelihood of substitution in the auto industry for use in auto catalysts?
I'll let you take that one, Rohit.
Sure. So, I mean, you're already seeing partial substitution of palladium with platinum in gasoline auto catalysts. So that is something that is already happening. We think that going forward, probably manufacturers of catalysts would keep all the metals in a mix, because if they move just to one or the other, the problem that we saw with palladium is likely to repeat with another metal. So if they were to move to platinum entirely, that sort of an issue could arise. in the platinum market as well. So I think going forward, what you're going to see is a mix of the metals in these catalysts. And yeah, as far as substitution is concerned, you're already seeing some of the palladium being substituted with platinum because of the price differential.
Okay, the following question is, how would the development of electric vehicles impact the demand for PGMs? And what are some major signs that one should be looking for?
You want to take it, Rhod?
Yeah, sure. So as far as electric vehicles are concerned, as I mentioned during the presentation, it is negative for PGM demand. It really depends on what you're referring to as an electric vehicle. If it's a pure electric vehicle or what is referred to as a battery electric vehicle, those are definitely negative for PGM demand because they don't contain autocatalysts. But you also have hybrids which still use catalysts. And so those are still supporting PGM demand from the auto sector. We do think that BEV market share would continue to rise going forward, but there's a lot of, and clearly electric vehicles have taken the lead in terms of alternatives to internal combustion engines, but that could change in the future if a technology comes along which makes more economic sense. And that could be, for example, fuel cells, or it could be something else. So that it's still evolving the way this will play out. At the moment, as it stands, clearly electric vehicles and battery electric vehicles seem to be the direction that all of this is going in.
I would add to that because we've done a lot of work on the energy transition, and we cue off of the International Energy Agency's work. And they have different scenarios, as anybody should have, different scenarios. And we don't use the scenarios that say, oh, we go to net zero carbon emissions by 2050. And we don't use the scenario that says all of the governments and corporations live up to their pledges in the Paris Accord. We use the International Energy Agency scenario that says, let's look at what's happened in the years since the Paris Accord. Let's see how governments and corporations and society and humankind have behaved. And let's assume that what we've seen over the last decade continues for the foreseeable future. And in that scenario, they have half of the vehicles in 2050, they have half the vehicles being built still burning some form of petroleum. They have a big growth in electric vehicles, but half of the vehicles are still using PGMs to clean up the exhaust from burning petroleum. Petroleum is still the largest source of energy in 2050 in their status quo scenario. And they did a study, I actually have it right here. They did a study in 2021. And in that study, they looked at the critical metal demand for the energy transition. And they said by 2050, our expectation is that the major use of platinum group metals in energy industry will be in catalytic converters, reducing and oxidizing hazardous emissions. So, the reality is that the energy transition is going to be much slower than a lot of people would like to see and say that they expect. And there's going to be all kinds of complications. Electric vehicles seem to have the lead right now, but that could change at some point in the next decade. And it's almost too early to tell. I wanted to address another issue that came in, and I apologize. I was a little bit distracted while Rohit was speaking about rhodium, but there were several questions about why the rhodium price fell. and why it fell so sharply in the second quarter of this year, and inventories. And as Rohit was discussing, the rhodium market has moved to a surplus over the last 2.5 years, and we have seen significant amounts of rhodium being produced both from scrap and from mine output relative to fabrication demand. And you've seen fabricators, the glass industry and the auto industry, reduce their platinum or their rhodium requirements per use. In 2021, there was a construction and crisis in China, and it continues today more or less. But there were several companies that were teetering on the brink of insolvency in the construction business. And one of the companies that did go insolvent was a company that made architectural glass. And they sold a significant amount of rhodium that they had in inventories, and that was in their glass manufacturing and fiberglass manufacturing industries. That was in 2021. In 2021, 2022, and early 2023, we've seen other glass manufacturers selling off excess inventories of rhodium. And that has been one of the factors, and it's not just one company, it's several companies, and it's not just one part of the world, it's pretty much global, although a lot of the glass manufacturing is now centered in one part of the world. That's been one of the key factors behind the lower price. I'm sorry, I did want to address that question because several people asked it, or permutations, mutations and versions of that. Okay, Carlos, next question.
Okay, following question is, what percentage increase would a conversion to hydrogen vehicles represent in the future for platinum?
Could you repeat that? What percentage?
What percentage increase would a conversion to hydrogen vehicles represent for the future of platinum?
Well, hydrogen fuel cell vehicles probably would use less platinum than current petroleum powered vehicles. So it would be a steep reduction in platinum, palladium, and rhodium. And then if you had a hydrogen engine, you would not need a catalytic converter, so you would not need platinum, palladium, or rhodium in a hydrogen engine powered vehicle. Now, there are people who are talking about using platinum or other PGMs in electrolyzers to make hydrogen by electrolyzing water. But again, don't take my word of it. Let's cue off of the International Energy Agency. The IEA has electrolyzers being a very slow to emerge technology, even by 2050. And they have very little PGMs being used in electrolyzers. And that has two things. One is electrolysis of water is likely to come much slower than some projections. But even within that, and you are seeing electrolysis of water, for example, at hydroelectric dams in various parts of the world where you have excess liquidity, electricity generating capacity. So in your off-peak hours, you use the excess electricity to generate hydrogen. You put it you attach it to a liquid organic hydrogen carrier. You store it until you need that energy during peak power demand periods, and then you strip off the hydrogen and you use it in turbines. That happens in Japan and in other countries as well. But within the electrolysis business, the alternative to platinum coated electrodes are titanium coated stainless steel electrodes. And the price difference in the raw materials is enormous, so that the IEA and others who look at it say they don't really see a big use for platinum in electrolysis of water to create hydrogen for either fuel cells or hydrogen engines or any other application.
Okay, the following question. Can you touch and expand on the South African PGM production issues, such as the energy uncertainty and so forth.
You want to take that one, Rohit?
Yeah, sure. So, I mean, there are a lot of issues that the South African mining industry has been faced with. They have been long-term issues. One of them is a shortfall in electricity. That's really the result of a lack of investment in electricity generating capacity in South Africa. And they have been trying to mend that problem now for several years. In the process, you're seeing the country struggles with rolling blackouts from time to time. So that has been a long-standing issue. It's something that is probably going to take several more years for it to get resolved. But that's not the only issue that the South African mining industry is faced with. They have issues related to, because it's deep level mining, they have issues related to safety. They have issues related to escalation and cost because of the need to cool those mines. It's narrow vein mining, which is not particularly supportive of mechanization, so that tends to further increase costs. So they have been struggling with a variety of problems, which include electricity, but also safety and just the deep level mining, which increases the cost of mining.
The following question, can you expand on the exploration and new discoveries of platinum deposits?
So I mean, there has been some, there hasn't been a lot of investment or efforts being made into developing new projects. There have been some projects in North America and in South Africa, which have been, they have been trying to develop them. There has been an increased focus in recent years on developing palladium rich ore bodies, both in South Africa as well as in North America. That's really the trend that you have been seeing in recent years as far as new projects is concerned. I don't know if that answers the question.
The following question is related to recycling in China. Given the massive increase in auto production and auto sales in China and the increased use in PGM loadings, I guess a decade or so ago, what is the expectation for a massive increase in recycling of those PGMs in China?
So, I mean, the Chinese passenger vehicle market is essentially a gasoline auto market. And over the last decade and a half or so, you have seen gasoline auto catalysts essentially being palladium rhodium catalysts. So a lot of that material, which will come back into recycling over the next several years, will contain large amounts of palladium as well as rhodium. It's really platinum which will not be increasing in a meaningful way. Most of that is coming in from the commercial vehicle sector, but from the passenger vehicle side of it, it's mostly palladium and rhodium. So we do expect that palladium scrap supply from China will rise in the coming years.
What is your outlook in palladium and platinum versus silver and gold?
So for gold and silver, we have them if you're talking about the short-term outlook, we have them all declining in the near term. If you're looking at the medium-term outlook, so 6 months out, we think gold and silver perform well. We have a lot of economic as well as political reasons to believe that gold and silver as portfolio diversifiers will perform well in the medium term. With regards to platinum and palladium, our expectation is that platinum performs better than palladium, or rather holds up better than palladium in the medium term. There are a lot of positive platinum fabrication demand fundamentals as well as supply side fundamentals, which should provide initial support, and then we think that platinum prices do begin to rise in the medium to long term. Palladium, meanwhile, is likely to not fall a whole lot more from where it is right now, but will struggle to increase because it does have a lot of headwinds for both fabrication demand as well as supply.
A question on minor PGMs. Does CPM have an iridium price forecast?
Yes, we do, but we don't make it publicly available. That's on the other side of the paywall.
Another question is, what's your sense of above ground inventories for platinum outside of ETFs, and how much do you think is being released into the market?
Well, we showed a chart, and there's quite a bit of platinum that's held there. The vast majority of investor platinum does not seem to be held in ETFs. There are several million ounces. What we've seen over the last couple years has been net additions to investor holdings. Some investors are buying, some are selling. But it seems like investors have been net buyers over the last couple of years. The Russian government has some platinum inventories. It has not been seen as a major seller for several years. It sees them as strategic metal to hold against the time when it might need that. Other governments don't seem to have much platinum group metals. The industry, producers and refiners, fabricators do have several million ounces of working inventories. They haven't been sellers. The producers and refiners may well have been adding to their inventories over the last few years. So we haven't really seen a lot of platinum coming into the market from refined inventories over the last few years. A lot of the people who bought the platinum are quite happy to hold it at $900, $1,000 an ounce. When we did see sales earlier from investors in 2011, 2014, it was at prices over $1,600 an ounce. So when the when the price fell below $1,600, several of those people stopped selling. They covered their remaining platinum inventories with shorts on the New York Mercantile Exchange platinum contract. When the price got down to $800 and started moving sideways for 8 years, they said, I don't need to hedge it further downside. So they liquidated their short positions, but they haven't necessarily resumed selling. Some of them seem to be waiting to see much higher platinum prices. And then the question will be, why is the price much higher? If the price has been trading between $800 and $1,000 for a decade by then, and all of a sudden it moves up to $1,500 or $1,600 or $1,800 an ounce, an investor is not going to say, oh, I can get $1,600 an ounce from my metal now, let me start selling again. He's going to say, why is the price risen so sharply so fast? And how far further is it going to go before I may want to sell? So we're seeing pretty strong, we're seeing a lot of platinum in inventories. I showed you the figures at the beginning of this presentation. But we're seeing very little interest in selling those inventories.
Okay, and the last question, can you make these slides available for the presentation? And will the presentation perhaps be available later on?
I'm going to ask Elliot to join us and answer that question.
The presentation should be available on YouTube within the next few hours. We can make the slides available as a PDF on our website, and we'll direct people to it.
I think all of the slides are in the yearbook. And not to be too much of a capitalist, at $160, the PGM yearbook is a really incredible source of information and knowledge that will help investors and others make good decisions. And the charts are probably all in that book. It's available online at our website for $160 as an ebook. It's probably worth the investment. If that's the last question, let me do that. We want to thank you. We hope that the last couple hours have been edifying and useful, providing useful information and insights. We were glad to answer some of those questions that people have put forth. Those questions are very important to us because it lets us know what it is that investors and others are wondering about and thinking about and what aspects of the markets they're looking at. So the two-way interaction is always important and it continues to be important. We thank you all for joining us, and this concludes our yearbook program for the year. Silver, gold, and platinum group metals yearbooks for 2023 have all been produced and released, and they're all available on our website. We will be doing other research, including our monthly reports and a lot of advisory work and our long-term projections over the next 6 months. And then we will be back in early 2024 with our gold and silver and platinum yearbooks in the first half of that year. And those should be much more interesting given what our expectations are for the economic and political and financial environment that we think will be here in 2024. In the meantime, take care of yourself, and we're around anytime you want to send us an email at info@cpmgroup.com. Let us know how we can help you. Thank you.